Well, welcome to Toronto. It's a little bit cooler than probably your time in Scottsdale, but
that's very
okay.
true. Yeah, a little bit of a shock to the system, but it's good. It gets you excited for what's ahead.
Absolutely. Becky is joining us today, and she's co-PM with Kyle Weaver, as some of you may know. But Becky, I have to ask you, I heard a really interesting story about you, and I need to verify if it's true.
Okay.
So I came back from leave, and I said, Becky Baker, I haven't had a chance to meet her. And one of my colleagues goes, she's amazing. She's so smart. She's actually a rocket scientist. Did you know that? And I said, oh my gosh, wow, that's impressive. So true, false?
I am not a rocket scientist, but if anyone wants to describe me that way, I'll take it. That's really funny.
We're starting the rumors here. That's the way it's going to go. Excellent. So tell us about your journey. You joined Fidelity, I'm assuming as an analyst, and worked your way up through the ranks. Talk about your journey. Talk about how you got to portfolio manager and where you are today.
Definitely. Yeah. So I joined Fidelity 12 years ago. I spent 7 years on the consumer team. That was my first team at the firm. I sort of moved around within that team. I covered leisure, travel, restaurants, some internet companies, a little bit of real estate exposed consumer. And towards the end of that period, I ran our leisure and travel fund. After that, I rotated, as many people do at Fidelity. I spent 3 years on the tech team. There again, I was covering stocks as an analyst, this time focused on payments, IT services, and software. I was also running the IT services fund. And then I was tapped to take on running one of the broader tech funds, which gave me exposure to semiconductors and parts of tech hardware. And so, again, kind of had a chance to see most of the sector over a period of a couple years. And then about 2 years ago, I joined Kyle Weaver on our U.S. growth strategies.
That's very exciting. And I mean, what great experience considering such a large portion of the fund has a tech focus at the current time.
Right.
But, for those of you that may not be familiar with U.S. Growth Opportunities Fund, talk to us about the investment philosophy that you and Kyle employ and, how you guys look at growth equity.
Definitely. Yeah. So it is a growth fund, and we're growth investors. We're bottom-up focused. We love uncovering new growth companies and learning their stories and building conviction to make them meaningful bets over time. Our stated philosophy is that we look for companies that we think look extremely cheap, like think less than 10 times earnings, looking out 3 to 7 years. And really the thinking there is that if we can find a stock where we think there's going to be significant enough earnings growth that it looks really cheap, looking out, some reasonable number of years, then you don't have to spend as much time thinking about valuation, because that sort of takes care of itself with the level of earnings upside. And so if the stock on our numbers is trading at, less than 10 times earnings, and we're right, then if it can trade at a market multiple, you have a double. And if it is a great company and trades at higher than a market multiple, you have an even better outcome than that. And so we spend most of our time trying to find these ideas and trying to underwrite some view of earnings, looking out a couple years that we think is out of consensus.
Excellent. And so when you're looking at these companies, I know you and Kyle like to bucket things into 3 groups, right? So you have your resilient businesses, you have strong long-term growers, and then you also have what you call these breakthrough tipping point opportunities. So talk about how you, when looking at companies, how do you determine which bucket they fit into?
Yeah. Okay. So the 3 bucket approach is not totally scientific, as might come through in the way that we talk about it. But we obviously think about all of the, traditional quant metrics, all of the risk metrics. We're aware of many different ways to slice risk across the fund. But then on top of that, we try to make sure that we don't have all the same kinds of growth stocks in the fund, so that if a certain type of stock goes in or out of favor, we can try to, use that and take advantage of the volatility. And so, as you said, we do try to put things in 3 different buckets. I'll start with the biggest bucket, which is the long-term growers. These are the stocks that look the most like the benchmark. So this would be like a Microsoft, a Meta, Boston Scientific would be another example. They're growing probably revenue in the teens. They have high margins, but in a lot of cases, we think margins can go up if we own the stock. They're great businesses run by great management teams. And within that bucket, even though these stocks look like the benchmark, we are trying, obviously, to own the ones that we think can do better than average. So today, that's 60, 65% of the fund. And then the remaining two buckets are sort of the tails. So on one side, we have the resilient bucket. These are stocks that like a value PM might own. So that would be Flex is an electronic manufacturing company. T-Mobile has been a long time large holding for the fund. These are generally slower growing businesses, but we think that there is earnings growth ahead. And that could be driven by, a business transformation. In the case of Flex, they've been under the leadership of a great CEO repositioning towards higher value add manufacturing, which has led to their margins really expanding and some strong revenue growth over a long period of time. In the case of T-Mobile, there's a huge cash generation story in addition to them being a very strong telecom operator. And so we think, with the buybacks that they're going to do, that there's actually a significant free cash flow per share growth story. So that's the resilient bucket, probably 15-ish% of the fund, 15 or 20. And then the breakthrough growth bucket is the most exciting one. These are the stories that are sort of, as you said, tipping point. They may be earlier stage in their growth runway. So this would be like a Carvana, where they have 1% share of all the cars sold in the U.S., but they're growing 50% year over year. They're taking a lot of share. And they're not always profitable today, but we see a path to profitability. And often that is what drives, the stock being able to look cheap looking out a couple years, because most of the time, this bucket looks really expensive on near-term earnings. And so that's probably another 15, 20% of the fund.
Excellent. So you mentioned Carvana. We might as well start there with the breaking point or breaking through category. Carvana, founder-led company. You and Kyle have a couple of those.
Yes.
So talk to us about, what makes you excited about those founder-led type companies that fall into that bucket. What are you seeing in that space?
Well, this is one of the most fun parts of the job because you get to know these stories over the course of a couple years. And so in the case of Carvana, I have to give Kyle a lot of credit because he found this one early. The fund made a lot of money on it. It was painful for a period of time, and he didn't exit it perfectly, but he exited it and saved the fund a lot of money and then made a lot of money on the way back up by buying it very close to the bottom. And so these are not always like sort of straight line stories, and Carvana is a perfect example of that. But they've repositioned, following like kind of the hardship that they had in 2022. They have dramatically improved profitability, and they just reported earnings last night. And some of the stats they shared in their shareholder letter, looking back at 2022 and comparing that to today, they're selling more units at higher profit per unit, with fewer employees per unit, less marketing per unit, less available inventory on the website. It's like every metric you could dream of is heading in the right direction for this company. And so to see the ability that they had to get the story back on course and, the way that they're positioned today, we think even though they only have 1% market share, is really encouraging because it just means there's that much more ahead for them. So that's one. Another one.
You probably don't have always good days when they report and things go as swimmingly as that.
No. And so that was a great earnings release. And as I said, that one's been a roller coaster. Yeah. And it kind of always is with these growth stocks. So that's why we have the three buckets. And that's why we try to take advantage of volatility, because you want to stick with them for the long term, but you can't necessarily be there in size the whole way, because you got to give yourself room if there's a big pullback that you can add to it, right. That it isn't so painful that you're sort of paralyzed. So Carvana is one of them. They reported last night, as I said, it was really a strong set of results. And then another one is AppLovin. What they do is advertising for mobile games, and they have dominated this market. It's incredible what they've done. And what we think is really exciting is, so they place ads within mobile games. And so far, really the advertising they've done is just for other mobile games. So if you're playing, I guess Candy Crush is a popular game, you may see an ad for another mobile game within that app. And AppLovin is sort of helping both sides of the transaction figure out who the right consumer is to see that ad. What's exciting for them going forward is that they're just now starting to branch out and show people ads for e-commerce, which, as you can imagine, is a much, much bigger market than just. Absolutely. So the results have been strong, but that's another one where there were a number of short reports over the course of the quarter. So we're talking to the company. We're going back through, the financials with the analysts, trying to make sure that we're really comfortable with everything. And so you get these opportunities in what looks like, I think, hopefully over a long period of time, a great breakout story that you wanted to own the whole way up, but often there's a little bit of volatility along the way. And so it can be a good opportunity to step in.
It sounds like you guys and Mark share the same view on F11. He's
okay,
a big fan as well.
I heard some of what he said, but I didn't hear him say that one.
He's a big fan.
Okay, there you go.
Let's take a step back. So we have to touch on, what your views of the market are. 2025 has been the most volatile I think most people have seen in a very long time. How are you and Kyle interpreting the market dynamics today? And what are you guys doing to just position yourselves, maybe in a stronger position for the long term?
Yeah, definitely is a volatile time. And I heard Mark talk about some of this too. I think none of us have really strong conviction about what all of this sort of trade war and global macro uncertainty will mean for companies and for the global economy. There's just a lot of moving pieces and a lot feels unpredictable, even relative to prior periods of uncertainty. So I was doing consumer and travel when COVID hit. And there was a lot of uncertainty then. But it was sort of one problem, right? We had a pandemic, people were locked at home, cruise lines and hotels were shut down, and restaurants were operating at really low capacity. And you sort of knew, we need a vaccine, we need masks, we need a way to cope with this. But eventually, the world is going to reopen.
Right.
And we're not going to stay like this. And this just feels so different from that. So anyway, I don't think we have a strong view about what to do about tariffs. And so while we do try to take advantage of uncertainty and step in when other people are fearful, I think we're trying to step in sort of in other ways. So one example would be in the U.S., housing is significantly underbuilt. And so we think housing could be a good secular growth story just because post the great financial crisis, there were not enough homes built. And then on top of that, in the last couple of years, we've had much higher interest rates, as everybody knows. And so that's been a headwind for this whole space. And, now people are worried about tariffs and the impact on building costs and all sorts of things. And so that space has been really a disaster for, 2 years. And there are a lot of companies that we think are operating well through a tough environment. And when eventually we get to the end of this, they could benefit. And so we're not there for the most extreme version of this. We don't own home builders, for example, but we do own a building products company that we think is well positioned. We own some home improvement retailers. We own some internet platforms that benefit from existing home sales whenever those come back. So I think we see areas like that where we can find great companies. We sort of know what the key issues are. We need relief on interest rates and housing affordability in the U.S., and eventually that will turn and those companies will come back. And that's the kind of place where we're stepping in. Tariffs, I think we're just kind of trying to stay away from taking a huge bet one way or another.
Completely understood. So, you talk about home building, long-term growth trends, though, that you're seeing. So that might be one of them. But other themes, other trends, AI has obviously been a big one. You guys are in the tech space. Views on that?
Yeah, you read my mind. We are still really excited about AI. And it's funny is the wrong word. It's interesting to me that AI has become so controversial over the past couple of months. And I think this may be another example, like I talked about with Carvana and AppLovin, where the long term can be really powerful, but you get this skittishness that comes and goes. And if you have the conviction to stay and add in these periods of volatility, it can really benefit and augment the returns for the long term. So I think there are a lot of reasons to be optimistic about AI. I'm sure many people here are using AI every day. I'm using it, I know, in the research process. When I can't remember a stat that a company gave, it's so much easier, right, to go and find it that way. When a healthcare stock releases data on clinical trials, I'll look at the press release, but then I'll go chat with the AI and say, what are the research analysts saying is positive and what are they saying that's negative, right? And it's such a great way to, learn about something. So people are using it for homework. They're using it for programming. There's just so many use cases, and I really think we're just getting started. So I think the long-term arc of AI can be very powerful, and we're real believers in that.
So are you guys more focused in the application of AI?
Good question, right. Yeah. So we're still, I think, mostly exposed to AI infrastructure because it's still early here. And what we're seeing in the AI infrastructure space is such strong growth that I think being too early to move away from that into applications and software, it could be a little painful. I mean, so for example, we just got CapEx numbers from all of the U.S. hyperscalers, which are like the big spenders on AI. I mean, there is a global story here too, but the big tech companies are a lot of the dollars, and they were up 70% year over year.
Wow.
And when you look at some of the, the companies on a company by company basis, like what they're spending in Q1 to get to the full year CapEx guidance, it's going to have to be up another 30 to 50%. So that's just this year. And then we have some proprietary data that we look at that looks out a couple years and looks at sort of like power purchases, land purchases. And that says that this is going to keep going, not at the same frenzy that we saw in 24. That was, I think, just the beginning of this arc. And so there was a little bit of a catch up, but I do think we're going to see multiple years of strong growth in AI CapEx, and it's going to pay to stay with this theme. And I think the other encouraging piece is not only are they sort of saying that they're going to spend it, but when you look at the companies that have moved the fastest, like Meta is one example, they're using AI for recommendations, and it's on two sides. It's on showing consumers the right content at the right time, so that drives better engagement. And showing consumers the right ad at the right time, and that drives conversion. And so what they're saying is just on a year over year basis compared to last year, which did have some AI already helping the numbers, that the new models that they have for what ad to show you are driving a mid-single digit uplift to click through. So that's pure revenue for them. Absolutely. And on a business doing 100, 200 billion of revenue, it's big numbers. And then on top of that, they're using AI on their advertiser-facing business. So if you're a small business and you go into the Meta, it's called Advantage Plus, their advertising platform, you give them like 5 examples of ads that you've shown to consumers in the past, and they'll use AI to create a bunch more examples in different languages, slightly change the creative depending on what that consumer might respond to, and then they'll place the ad for you. So you don't have to say, I'm targeting young women, or I'm targeting older men, or I'm targeting, people of these demographics. They'll figure that out for you. And so that they just launched it. I don't know if it's a year, 2 years ago, this new advertising platform, but they said, this is a quarter ago now, but it's a $20 billion business for them. Wow. So again, more than 10% of their revenue coming from something that is powered by AI and machine learning. So I think it just makes sense. I mean, if you're seeing returns like that, why wouldn't you keep spending? And so that's a theme we're still excited about, and it's a big part of the fund. Well,
that's a perfect segue, because Meg 7 is obviously always a hot topic, just because there's a lot of questions around valuation and, they're as big as they are. Should we still be there? I know you and Kyle have some very passionate thoughts around the Meg 7. So perhaps share those with us, and, maybe just touch on the portfolio's largest holdings, because there's a lot of overlap there.
Yeah. Okay. Well, I'll channel Kyle first, because what he would say is
channel your inner Kyle.
Yeah, exactly. So Kyle would say, be careful, because the Mag 7 is not all one story, right? And there is a lot of dispersion in performance. So that is a fair point. We talk about these stocks together because they're all big tech companies, and they do have other things in common, but they don't all trade together. So I think that is a point of caution that Kyle always starts with. And I think it's a good place to start. So I'll channel him.
It's like a disclaimer.
Exactly. But I do think, there's so much incentive, or it's so tempting to bet against the Mag 7 because they've gone up their exposure. They're bigger components of the index. From my seat, I wish that they were not so well positioned, because my goodness, it would be easier to beat a benchmark that wasn't almost 50%, companies that are this well positioned. But I think it's dangerous to bet against them. So it's about 50% of the fund that's in those 7 companies. It's not in all 7 of them, but in 6 of the 7 in a pretty sizable way. And I think part of what makes us, I'll say, like hesitant to bet against them and respectful of how high the bar is that they set for other holdings in the fund, like a Carvana or an AppLovin, like really have to work,
right,
if they're going to beat these Mag 7 names. What sets the bar so high is, number one, these core businesses are incredibly healthy. So like in the case of Facebook, you've got Facebook, Instagram, WhatsApp are all healthy growing businesses. They're growing users, they're growing advertisers. As I said, conversion rates are going up. Like there's a lot of positive to talk about there. AWS, the marketplace, or Amazon, AWS is growing, the marketplace is growing, like a lot of positivity there. Apple, even though they don't grow as fast as the others, they have 2 billion installed users that they can monetize and that do not churn. So I think it's a very powerful position. And especially as we head into a world of AI, they have a lot of power as like the device in everybody's pocket. And I could just keep going through these stocks. But when you look at them, I mean, the average of that group is growing revenue 10%, expanding margins. And that's even with this CapEx boom that's driving higher depreciation. And so I think the core businesses are healthy. I think they're laying the groundwork for the next wave of growth. So whether that's like Meta, WhatsApp is the next growth driver for them. Microsoft has AI as the next growth driver for them. Tesla has battery storage. It's almost a quarter of gross profit, and I think could be a powerful story looking out a couple years. So I think there are reasons to think like sort of the next chapter can be positive. And then they're well positioned in AI. They have tons of capital. They have engineers. They have huge user bases. And most of them, they're not all cheap, but some of them are not expensive. They don't even trade at a premium to the market. So I think that they're well positioned. And as much as we're watching for cracks, because we would love to be able to, sell out of one and put it into some new undiscovered idea, I think it's periods like this where they underperform by like a little. Yeah. And that's kind of when you want to be stepping in.
Fair enough. So speaking of, selling, talk about your framework around how you exit positions, because that's a big part of what we do as what you do as active managers, is, making sure that your thesis is always aligned with what you're holding. So what do you guys do to, understand this is the time to go?
Yeah, I think there's always a little bit of push and pull here, because I think among growth investors, there are sort of two schools of thought. One is when you find a great growth story that's got the fundamentals working, that can often sort of build on itself. And I take myself back to doing leisure and travel stocks and in franchise hotels, for example. You have this momentum where when your RevPAR, that's like their key price metric, when your RevPAR is going up, your franchisees are making more money. When your franchisees are making more money, they're building more hotels. When your franchisees are seeing their pricing go up and they're building more hotels, your advertising budget grows. When your advertising budget grows, you can reach more consumers. When you can reach more consumers, you can have more loyalty users. They come back to you more frequently, and the cycle kind of keeps going, right?
Yeah.
And so that's the case. I mean, that's just one example from my, old group. But I think that this idea of fundamental momentum being something that kind of feeds on itself is powerful and is what creates this whole school of thought that you want to stay with your winners. You don't want to, what do people say? You don't want to trim your flowers to water your weeds. I think it makes a lot of sense, right? So that's one school of thought. And then there's this other side that says, but yeah, if a stock's gone up 5x, 10x, 30x in the case of some of these really breakout growth stories, the bet size is going to be a lot bigger. And you are not going to have conviction to add when you inevitably hit something like we've already given examples of. And so I think that Kyle and I try to hang on. We try to be slow sellers of our winners, but we do try to trim them so that we can add back when we see opportunities. And I would say we're probably in the breakthrough growth bucket. We're more willing to trim because you can have such big outcomes. In the more compounder bucket, that sort of long-term growers, the Microsofts, the Boston Scientifics, it's not quite as important because you don't tend to get these sort of enormous moves that can change the total composition of the fund. And so I think we do try to sort of take advantage of volatility and trim our winners. But the other side of this is, what do you do with your losers, right? Do you add, try to take advantage of weakness? And there, I think we tend to kind of fall on the other side, where normally when things are getting worse for a company, when they're missing numbers, it's hard for the management team to fully appreciate the challenges that are weighing on the business. And often if it's something competitive, they may not even see it as well as we can from the outside because we're paying more attention to the industry than they are. And so I think we've been more discerning about exiting our losers. And so what you may see from the outside is that our name count has come down some. And this started when we started working together about 2 years ago. Last summer, we had our trading team run a look back at, did we make good decisions as traders? Was it a good decision to trim on the way up and, kind of sell out of some of our losers and try to repurpose those funds into new ideas? And the answer was yes. So we did add value both on the buy side and on the sell side. And so I think that's been conviction building. It's an exercise that we're going to keep doing each year, because we want to make sure we're making the right decisions. But so far, we feel like, this is working for us.
And I think Kyle attributed actually to you joining the team when you guys went through that exercise, made some moves, and that's turned out to be quite successful. So
yeah, well,
kudos.
we didn't start with this, but I mean, that Kyle has an incredible long-term track record, and he is a brilliant investor. And I learn so much from working with him. I mean, we have like such a great partnership, and I feel lucky that we have the sort of easy relationship that we do. But that was part of it, was he felt like both of us like to go very deep on specific stories. And so with, more than 100 names in the fund, even just on the public side, it's hard to stay on top of that number of ideas. And so especially the long tail of smaller bets, I think he felt like he needed a second set of eyes to go through. And so that's where I started when I joined him, was not on the, gigantic bets that he's known forever, because he knows those well and I trust him. Right. It was on the smaller things. And so we exited a bunch of those, and that was, I think, a good decision. And now we're sort of in this routine. I think it's been a good practice.
Excellent. We only have 3 minutes left. So 2 questions to wrap things up. Risk obviously is a big component of what you do, because as much as it's fun to pursue all these growth companies, in times like we're in now, that's not always easy to do. So how do you manage risk within the portfolio?
Yeah, I think during periods that we foresee heightened volatility, we try to be out in front of that. And I think we feel pretty good about our execution this year. And I think that's because we saw some of this coming, and we did take risk down in advance of some of the issues that have come out in the last couple weeks. And so we're running with a level of risk that is sort of similar to the benchmark, which is low for us, because normally we are looking for these exciting growth stories. And so periods of market volatility tend to be tougher, but I think we came into this one a little better positioned. And I think we feel good about the balance that we have. Like I said, in each of the buckets, we're trying to find, we hope, the best stories. And so we don't necessarily feel like we need to be full tilt breakthrough growth right now, because we are finding great ideas across the spectrum, and we just want to have some firepower if we do see some real downside, that we can, step in a bigger way.
Absolutely. Final thoughts, key messages, takeaways that you want to leave our audience and those online with today around the Fidelity U.S. Growth Opportunities Fund.
Well, thank you for having me. I'm really excited to be working for a Canadian shareholder base, and we're working hard to find growth stocks. Hopefully you heard my excitement about AI, my confidence in the Mag 7. Some of these breakthrough growth stories we think are, like, we found good ones, and we're happy. Like, we just had earnings season. We're seeing cards turnover. Like, the AI cards have been good. These company-specific breakthrough growth stories have been good. And so we don't really know where we're headed this year.
Right.
There's a lot of volatility out there, but so far what we're seeing makes us feel like we have the right names in the fund. So we're going to keep working hard for everybody.
Well, thank you for everything you do. That's Becky Baker, everyone.
Thank you.
Great job.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.